Ladies and gentlemen, grateful thanks from all of us at Manoj Chaudhary and Associates to each one of you for joining this webinar. So I begin now with the assistance of my partner Mitsu. We'll be taking you through some of the most common issues that we come across when we service our non-resident clients. Most important thing for all of you to understand is your NRI status. Now, NRI as a non-resident Indian, all of you would probably be loosely talking about the term NRI or about the non-resident, etc. in your daily communication. You need to understand that under Income Tax Act there is nothing called NRI. NRI is just a generic term which we use in our day-to-day language, but for tax purposes, what is more important is your tax residency status. It could either be resident and ordinarily resident, second could be non-resident, and third could be the hybrid status of resident but not ordinarily resident, or as it's popularly known as, for short, RNOR. So the most important thing for all of you as non-residents from an income tax perspective is to first be very clear as to what is your residential status in India every year. So for every financial year, April to March, you need to, actually put down in a table how many days of stay did you have in India or outside India. And then based on that, your tax consultant would tell you what is your residential status for tax purposes in that. Why is it important to know your tax status, or what is the relevance of the residential status is that as a non-resident, if you are a non-resident for tax purposes, then only that income which is earned, stroke received, stroke accrued in India, which is taxable in India. And with effect from financial year 2023-24, for which we just recently filed the returns, I hope that all of you also have filed your tax returns if you were required to file your tax returns. For that year, the default regime is the new tax regime. A lot has been said about this in the budget and in the media also. So the old tax regime, if it is beneficial to you, then you have to specifically select that old tax regime while filing your tax return. Otherwise, by default, it will be assumed that you have filed under the new tax regime. Now, NRIs are not required. This is important because there were a lot of queries on this also. That if I am a non-resident, am I supposed to disclose my income earned in my home country? That is, wherever you are, Canada, USA, Belgium, Netherlands, whatever it is. So are you supposed to disclose that foreign income in India? The answer is clearly no. If you are, and I repeat, I'm not talking about NRIs, I'm talking about a person who is non-resident for tax purposes in India. If you are a non-resident, you're not only not required to disclose, you're not only not required to pay the tax on foreign income, but you also don't need to disclose the foreign income or your foreign assets in the ITR form. Let's move, Mitsu. Yeah. So when you are while you are a non-resident, you would have earned income outside India. And as I mentioned earlier, that is not taxable in India. So there were a few questions on, can I bring that money into India? And if I bring that, what is the tax implication of that? Very clearly, when you were a non-resident and you earn income outside India, that income was not taxable in India in those years. And therefore, when you bring it back also, that capital amount, that principal amount, that whatever you bring back to India, that has got no tax implications in India in the year in which you bring that money into it. But do remember that once you become a resident for tax purposes in India, your global income is taxable in India. Therefore, let us take a case that somebody was in Singapore for many years, came back to India, but continued to hold some bank accounts in Singapore or some investments in Singapore. The income that you earn on that Singapore asset or that Singapore bank account that income will get now taxable in India, subject to the applicable double tax avoidance agreement or DTAA, if any, between India and that country. In the example that I gave, Singapore, of course, there is a treaty between India and Singapore, and India has tax treaties with lots of countries, more than 100 countries. So one can look at the DTAA and see whether you can take benefit of the DTAA and get any tax concession in India for the tax that you may have already paid in that other country. While you are a non-resident, if your foreign salary, so you may be, you're working somewhere in any other country, you're earning salary in that country. Sometimes what people do is that they give instructions to their employer to directly send the the salary figure into the Indian bank account. I think this is something that is not a well thought of plan, because as we saw earlier, in case of resident, any income which is earned or received or accrued in India is taxable in India. So while this salary income is earned outside India, if the salary income accrues outside India, but if it is directly received in India into your bank account, you will have a problem because technically that income becomes taxable in India. Therefore, please do not give any standing instructions to your employer to send your salary income directly into India. Here, I may just caution that there were a lot of questions about mariners, about seafarers, about shippies, and their tax problems. What I just mentioned about salary being directly received into India, getting taxed in India, even though it is earned outside India, this does not apply to shippies. We'll come to shippies a bit later, but uh, for shippies, there is a different provision. But for any other person, salary earned outside India but directly remitted to India will be a problem in as far as India is concerned. Now, if you are a non-resident, then following, you would be having various kinds of income in India. In our experience, generally, a non-resident has interest income. Maybe it is from NRO account, NRE account, etc., or FCNR account. You would have interest, and some NRs have unfortunately not even converted their bank accounts into NR accounts. Therefore, they may have a normal bank account over here in India, savings account. All that interest income is generally what you earn in India. Then you could be earning dividend, whether it is on shares or whether it is on mutual funds. You could have probably rented out your property in India and are earning rental income. You could have capital gains from sale of immobile property, from sale of shares, from sale of mutual fund, etc. Or you could have any other taxable income. Can't think of, but generally I've mentioned it as a residual bullet point. On all these items, unfortunately, there will be a withholding tax or a TDS. All of you would be aware of that. On your NRO interest, for example, there is a straight 30% deduction of TDS by the Kotak Bank or by any other bank for that matter. Similarly, on rent income, there will be a 30% deduction at source because you're a non-resident. Now, and of course, on NRE interest, on FCNR interest, there is no tax payable. I just mentioned that that could be a source of income, but on NRE interest, it's an exempt income. So therefore, there is no tax payable on that. There will be no withholding tax on that. But many times people have a problem with this high rate of TDS, 30% on the interest, on rent, etc. Is there a way out? Can we reduce the TDS amount? Yes, there is a way of reducing it, and which is when you make an application to your income tax officer for what is known as a nil or a low withholding tax certificate. The relevant section of the Income Tax Act is Section 197. However, it is a very cumbersome process to get that certificate. So most people, either are not aware of this, or even if they are aware, they don't go in for it because it is extremely cumbersome to get that certificate. Anand mentioned that there were queries relating to what ITR form should be filed. Generally, in our experience, only two ITR forms are applicable. Two non-residents, ITR 2 and ITR 3. ITR 3 is applicable only if you have, profits and gains of business in income in India. But otherwise, invariably, a person not having business income, or having taxable capital gains or income from more than one house property, ITR 2 would be applicable. Uh, yeah, so generally ITR 2 is filed by non-residents. Now, there were lots of questions on, I am a non-resident, am I mandatorily required to file a tax return in India? The answer to that lies in this slide. NRIs have to file ITR in India if their taxable annual income exceeds 2.5 lakhs if you are going in for the old regime and 3 lakhs if you are going in for the new tax regime. So the general rule is unless your taxable income is below the threshold limit, you have to compulsorily file a tax return. Now, even if your income is below taxable limit, if you satisfy any of these other conditions, then you still need to file a tax return in India. Some of the situations in which mandatory filing is required, even if your income is below taxable limit. And in case of non-residents, generally it would be the last item, that is aggregate of TDS and TCS exceeds 25,000 rupees. So if your TDS, say, let us take an example, you have interest on NRO account of 1 lakh rupees. Now 1 lakh, and there is absolutely no other income. Okay. So on 1 lakh is less than the threshold limit, both under the old regime as well as new regime. But the bank would have deducted 30,000 at source as TDS from that 1 lakh of NRO interest. Because that 30,000 TDS is exceeding 25,000 rupees, you still need to file a tax return mandatorily. If you do not file your tax return in this kind of a situation, they can penalize you for not filing the tax return. So just keep that in mind. Now, we saw when it is mandatory to file the return, but even if it is not compulsorily, you're not compulsorily required to file a tax return in India, you can still file a tax return in India. You have the option of filing the tax return. And one person had asked that I have not filed my tax return for last 20 years. I want to start. Is there a problem? There's absolutely no problem. Just because you have not filed for last 20 years or even 50 years, it doesn't matter. You can definitely file your tax return in India now, starting any point of time. As a general rule, you need to disclose your taxable income as well as exempt income in the ITR form. So in the ITR form, there are fields for showing your taxable income, and there is a field for showing your exempt income. So interest on NRO account will go in taxable income. Interest on FCNR, interest on NRE account will go under the exempt income field of the ITR form. The due dates for filing the tax return generally for NRI, it would be 31st July. We have not come across any NRI who has any of the other due dates, so we'll not go into that. But so therefore, for FY 23-24, the due date is gone. 31st July 2024 is well past. But we'll still file the tax return for that year before 31st December 2024 by filing a belated return. We spoke about the new tax regime, which is mandatorily effective from AY 24-25, that is last year. But in this budget, they have made changes in the slabs and the threshold, in the tax rates. And therefore, for current financial year, FY 24-25, which is relevant to assessment year 25-26, for which you will file your return next year around June or July 2025. In that year, for this year, the threshold, the tax slabs and the tax rates are given 3 lakh. So up to 3 lakhs, no tax. If your income is between 3 lakh 1 and 7 lakh, or whatever is the figure, 5%. If your income is more than 7 lakhs, then on the first 3 lakh, no tax. First, the 3 lakh to 7 lakh, 5%. And on amount exceeding 7 lakh up to 10 lakh, 10%. So on and so forth. So very clearly under the new regime, the maximum bracket of 30% applies to your income, which is exceeding 15 lakhs. Now, those of you who were watching the finance minister when she presented the budget in July 24 may remember that she said again and again that now up to 7 lakhs, you effectively don't need to pay tax. Unfortunately, that applies only to residents. For non-residents, this table would squarely apply. For residents, there is a rebate under section 87A, which because of which effectively up to income of 7 lakhs, you effectively pay no tax. Uh, Somebody asked whether for the purpose of 2.5 lakhs, whether NRI interest is to be considered. Answer is no. What we are talking about as far as threshold is concerned is taxable income and nothing else. Exempt income is not to be included. Some disclosures which are required to be made by NRIs in their ITR form. If you're a director in an Indian company, you need to disclose the details of those companies in the ITR form. If your income is more than 50 lakhs, again I repeat, not NRE interest, your taxable income is more than 50 lakhs, then not only you, but even residents. So this applies to residents as well as non-residents. If your taxable income in India is more than 50 lakhs, there is a separate schedule called Schedule AL, in which you need to give details of certain assets held by you in India. Again, I repeat what I mentioned earlier. Foreign assets are not to be disclosed by non-residents. They are not interested in that. But in India, if you have any of those assets like immovable property, jewelry, vehicles, bank accounts, shares, mutual funds, etc., those need to be disclosed in your ITR form if your taxable income is more than 50 lakhs. There were a lot of questions on capital gains, and especially after the budget, which the new government presented in July 2024, because the whole capital gains have undergone complete disruption. We have given this table over here, and there are multiple other tables coming in the subsequent slides. I don't want to get into the details because this will, it will be there with you when you ask for a copy of this presentation. But I just wanted to highlight that in respect of so what has happened is basically they have tried to streamline the whole capital gains taxation. Earlier, for an asset to be classified as long term, there were three different periods which applied to different assets: 12 months, 24 months, 36 months. Now, after the last budget, we have only two sort of holding periods: 12 months and 24 months. So there is no 36 months. Therefore, we have tried to capture the difference which has been made by the latest budget, which is effective from 23rd July 2024. So transfers that took place before 23rd July 2024, the old law applied, and under the old law, in certain cases, the holding period for categorizing the asset as long term was 36 months. You needed to hold it for more than 36 months. But post 23rd July, if you have sold an asset, then the classification of the asset into short term and long term will be as per the new law, where 36 months is now no longer applicable, it is only 24 months. So you may keep this in mind. We come to the tax rates. So as I mentioned, in the latest budget of July 24, the classification of capital, the classification of assets in short term and long term underwent a change, and they have streamlined the holding period only in two now, 12 and 24. Similarly, they have also streamlined the tax rates. So earlier we had multiple tax rates: 10%, 15%, 20%. Now they have brought in only two tax rates for capital gains: 20% and 12.5%. It depends on what kind of asset is there that you have sold, and so this is a I think in the process of streamlining the whole capital gains, the whole identification of the asset, the taxation of the asset has become extremely complicated, because now for part of the year there is a different law, for the balance part of the year there is a different law, different slabs, etc. But suffice it to say that in respect of the most popular asset, which is equity shares, listed equity shares, and equity oriented mutual fund units, let's just go back to the earlier one. Yeah. In respect of equity shares and on which STT is paid, and in respect of equity oriented mutual funds on which STT is paid, post 23rd July 2024, the tax rate for short term would be 20%, and for long term without indexation would be 12.5%. This is important. And then in subsequent slide, just next one. Yeah, immobile property. Immobile property. Yeah, immobile property up till 23rd July. In respect of immobile property, the short-term capital gains was a normal rate, slab rate. It continues to be the slab rate post 23rd July as well. But importantly, the long-term capital gains on sale of immobile property, which was earlier 20% after indexing the cost, is now 12.5% without indexation. This is a big change that impacts non-residents, uh, because earlier everyone got the benefit of indexation and paid tax at 20%. But now for non-residents, indexation has been done away with completely. For residents, for properties which were acquired prior to 23rd July and which are sold post 23rd July also, the option of paying tax at 20% on indexed gain has still been made available because of the huge, furor that was caused by the budget. But that advantage has not been passed to the non-residents. So therefore, for properties which are acquired prior to 23rd July 2024, resident taxpayer has the option of paying tax at 20% on indexed gain or 12.5% on unindexed gain. But for non-residents, you have to compulsorily pay tax at 12.5% on unindexed gains. Just to give you an example, purchase date in this case of a property, this is all with respect to immobile property or residential house property. Let us say this person had acquired the property on 1st April 1999 and has sold the property on 31st August 2024, that is post 23rd July 2024. Now here, if you see what has been highlighted in yellow is fair market value, FMV is fair market value as on 1st April 2001. Now, why is this taken instead of the actual cost? Because there is a provision in the Income Tax Act which says that for any asset acquired, any asset, not only immobile property, any asset acquired prior to 1st April 2001, you have the option of substituting your actual cost with the fair market value as on 1st April 2001. So in this example, the fair market value as on 1st April 2001 was 50 lakhs. The property sold for 3 crores on 31st August. The cost inflation index for the year of purchase is 100. Cost inflation index for year of sale is 363. Had this property been sold, say on 30th June 24, that is before the amendment, then the taxation would have worked like this. The capital gain would have been worked like this, would have been calculated like this. 3 crore sale consideration, indexed cost of acquisition, 1 crore 18 lakh 50,000, which is 50 lakhs FMV as on 1/4/2001, multiply by 363, divide by 100, and on the capital gains of 1 crore 18 lakhs, tax would have been 20%, which would have been 23 lakh 70,000. But because the property is sold post 23rd July, that is 31st August, in respect of a non-resident, the capital gain will be calculated as 3 crore minus 50 lakhs, that is unindexed cost or unindexed FMV as on 1st April 2001. Capital gains is 2.5 crores. 12.5% tax on that is 31 lakh 25,000. So it's very clearly visible from this that for non-residents in this particular kind of a situation, the new regime will result in a higher tax outflow as compared to the old regime. Yeah. Yeah. Another example, property is bought on 1st July 2016, sold on 31st August 24 for 3 crores, and cost was 50 lakhs. In 2016, somebody had bought a property for 50 lakhs, it is being sold now for 3 crores. In this example, if under the old regime, indexed gain, the tax at 20% works out to 46 lakh 25. But under the new regime, under the new law, which is applicable to non-residents compulsorily, where you cannot index your cost, the tax liability is 31 lakh 25. So we are just trying to sort of illustrate the point that the new tax regime for capital gains, whereby indexation is not available and long-term capital gains is taxed at 12.5%, could be beneficial to some and could not be beneficial to some. This is the sum and substance of the two illustrations. Which brings me to the question, to the aspect of gifts and inheritances. There were lots of questions on gifts, and every webinar we have seen questions. I think first you understand that what is a gift. A gift is when any sum of money is received without consideration. It will be treated as a monetary gift. Any specified movable property received without consideration would be termed as a gift of movable property. And similarly, in respect of immovable property, same way. You receive it without consideration or even for inadequate consideration. In all these cases, it would be treated as a gift in your hand. Yeah. Next slide. Yeah. So what I mentioned earlier in the earlier slide, the specified movable property. So what is specified? Shares, jewelry, archaeological collection, drawings, paintings, sculptures, etc. If you get a gift of any of these, it would be treated as a gift without consideration and would be taxable. I'll come to the tax part, but basically what is covered under gift would be this. In respect of immovable property, it would be land or a building, whether commercial or residential. First things to be understood by you is that there is no gift tax act in India. We had a gift tax act long back, but it was abolished long back. What has now happened is that gifts in excess of 50,000, gifts received by a person in excess of 50,000 are taxable in the hands of the recipient, in some cases, as income from other sources. In no case is the donor, that is the person who is giving the gift, having to pay any tax. So for as far as donor or the person giving the gift is concerned, there is no tax implication. The tax implication, if any, is only in the hands of the recipient or the receiver of the gift. We are talking about gifts received in India. So if a non-resident receives a gift outside India, Indian Income Tax Department has nothing to do with this. There is no tax implication in India. Just 1 minute. Gifts received outside India, not within the purview of taxable income for a non-resident. Okay. Now, how is the gift to be taxed? If you receive any gift in the form of money, cash or bank, check, etc., in your bank account, if it is more than 50,000, then the question of taxation arises. There are certain exclusions. I'll come to that, but broadly, we are talking only about gifts in excess of 50,000. If the gift is less than 50,000, there is no question of any tax. You don't need to look further. Similarly, in respect of gift of other than money, that is movable property, where the aggregate fair market value of the property is more than 50,000, then the question of taxation arises, and that also only in respect of the difference between the fair market value and the consideration, if any. So if it is for some consideration, then the 50,000, whatever is in excess of 50,000 less the consideration would need to be taxed. The fair market value, what is FMV? It is the price at which the asset can be disposed of in the open market on the valuation. If purchased from a registered dealer, then it is the invoice value. Where the FMV of the movable asset is more than 50,000, SSE or the recipient, that is the person who receives the gift, will have to obtain a report from a registered value in respect of the movable property. In immovable property, same thing, more than 50,000. But here the difference is that, or the difference between a movable property and immovable property is that difference between the stamp duty value of the immovable property and the consideration has to be examined. So unlike the earlier one where it was referring to FMV or the fair market value, as far as the immovable property is concerned, it is the stamp duty value. And we'll illustrate how this works. But gifts received from relatives are exempt from the provisions of taxation under this section. So, what is a relative? In case of an individual, and this is all with reference to the person who receives the gift. So, the person receiving the gift has to check whether the person who has given the gift is my relative or not. And who is my relative? My spouse, my brother or sister, the brother or sister of my spouse, brother or sister of my parents, any lineal ascendant or descendant, which means my parents, grandparents, etc., or my children or my grandchildren, any lineal ascendant or descendant, any lineal ascendant or descendant of the spouse of the individual, meaning my wife's parents or grandparents. If I get a gift from them, they are treated as relative under this particular section, as far as I am concerned. So, if I receive any gift from any of these specified relatives, that gift is outside the purview of taxation. So there were a lot of questions. Can I send a gift to my son, to my parents, etc., etc.? Yes, if you are staying outside India, you want to make a gift to any of the persons mentioned over here, for whom you will be a relative. So therefore, for example, if you want to give a gift to your children here, you want to give a gift to your parents, you want to give a gift to your in-laws, all those would, the recipients will have no problem as far as tax is concerned. You as the donor, of course, have no problem, which I already mentioned, that the donor is not, there is no tax implication for the donor. I hope this answers a lot of questions which had come up on the gifting. Then similarly, money received on the occasion of marriage of the individual, money received from a local authority. There are some other exemptions as well, but these are not very relevant except for the one about the marriage. So if you are getting married in India and at the time of marriage you receive gifts from your friends, relatives, family members, etc., independent, even if they are from non-relatives, irrespective of the amount involved, those gifts would not be taxable in your hands. So let's take an example. Mr. A receives 10,000 each from his friends X, Y, and Z as gifts. The total amount of the gifts, so X, Y, and Z are friends, so they are not relatives as far as this person is concerned. And therefore, and also the total amount does not exceed 30,000. Therefore, this amount of 30,000 will not be taxable in the hands of Mr. A. Another example, Mr. A receives 5,000 from his friend X, 1,000 from his neighbor Y, and 70,000 from his local MLA Z as gifts. So he has got 76,000 as gifts. Now, the entire 76,000 will be taxable in his hands because none of the three, that is friend, neighbor, or MLA, are related to him or fall in the definition of relatives. And therefore, because 76,000 exceeds 50,000, the entire amount would be taxable in his hand. Please note that it is not that first 50 is exempt and only 26 is taxable. The entire 76,000 would be taxable. Yeah, Mr. A receives 25,000 from his friend X, 10,000 from friend Y, and 70,000 from his father Z as gifts. So what is to be noted here is total in gifts received is 1,05,000, which is more than 50. But out of that, 70,000 is from the father. Father falls in the definition of relative. So that 70,000 goes out. What remains is 25 plus 10, 35. 35 is below 50,000. Therefore, nothing is taxable in the hands of Mr. A. Somebody mentioned, I think, about some prize money and all that. Prize money is not a gift that has got a different, tax implication altogether. I don't want to get into that. Right now, we are talking about gifts. Okay, now you've got a gift in terms of an asset. The money part is easy to handle, but if you've got an asset as a gift, then how do you determine the cost of acquisition of that gifted asset in your hands? So it's very simple, and this applies to every asset, whether immovable property or mobile property. Whatever was the cost in the hands of the earlier owner is deemed to be the cost in the hands of the person who gets the gift. So it's very simple. if, for example, your father has gifted you a house in India, the cost of the house in the hands of your father was say 1 crore, then that 1 crore becomes your deemed cost uh, in respect of the gifted house property. The same thing will apply to cost of improvement also. Any expenses which were incurred by the earlier owner for the improvement of the asset would get treated as cost of improvement in the hands of that person, and therefore it will also be deemed to be cost of improvement in your hands as well. Yeah. So let us take an example. A received the immovable property from his friend X. One situation could be without consideration, the other could be with inadequate consideration. There is a consideration, but it is inadequate. So let's see how it would work out. Let us take an example. The actual consideration is 100. The stamp duty value of the immobile property is 90. So basically, there is a consideration which is in excess of the stamp duty value. So there is no gift that the person has received. But if the stamp duty value was 150, so if somebody has got a gift but paid 100 rupees to the donor, but the stamp duty value is 150, then 150 minus 100 is 50. So 50 rupees would be the gift in the hands of the recipient. On another example, stamp duty value is 102 and the consideration paid is 100. Now the difference is 2. So there is a difference between stamp duty value and the consideration. But that 2 rupees, that difference of 2 rupees falls within the safe harbor of 10% which is given. And therefore, there would be no tax implication in this case as well. If there is no consideration, okay, if the consideration is nil, but the stamp duty value is 100, then the entire 100 minus 0 is 100. The 100 rupee would be deemed to be, would be treated as the value of the gift and would be taxed in the hands of the recipient or donor. This brings us to inherited assets. We talked about gifted assets. We now move on to inheritance. Upon demise of a family member, you may inherit some assets, whether bank account, whether shares, mutual funds, etc. Or a house property. You could inherit any asset from a deceased family member. When you receive an asset on inheritance, move. Yeah, at the time of inheritance, when you inherit, that time there is no tax implication for anybody because that is not even treated as a transfer. So the transfer on the demise of someone, as per the will of that person, when the asset shifts to the legal heir, that particular movement of asset is not treated as a transfer for capital gains purposes. So therefore, at the point of inheritance, there is no tax implication for anybody. But when that inherited asset is transferred ultimately and later on, at that time, obviously, there will be taxation and it will depend on the nature of the income one. When capital assets are inherited or gifted and subsequently sold, it will give rise to capital gains. The taxpayer will have to, first be clear as to whether that asset is a short-term capital asset or a long-term capital asset. And depending on that, the capital gains will be calculated and the taxation will work for that person. We already spoke about how, what is the holding period, etc., for classifying it as short-term, long-term, what is the tax rate, etc. All those will apply to this particular inherited asset as well. Let's take an example. Rahul's father gifted or bequeathed a flat in April 2023. The father had purchased the flat in 2012 for 90 lakhs. Now Rahul proposes to sell this flat in Jan 25 for a consideration of 1 crore 50 lakhs, 150 lakhs. He will need to calculate the capital gains from sale of this flat by considering the cost of acquisition at 90 lakhs. I mentioned earlier, in respect of gifted property or inherited property, the cost in the hands of the earlier owner will be deemed to be your Therefore, for calculating capital gains in January 25, when Rahul sells the flat, the cost will be 90. The holding period will be from 2012 to 2025, obviously more than 24 months. Therefore, it is a long-term capital gain. And the capital gains would be 1 crore 50 minus 90, 60 lakhs. And at that point of time, the tax rate applicable would be 12.5% on the unindexed gain, and he'll have to pay tax accordingly. Another example, X purchased a house in May 12 for 50 lakhs. Y inherited the residential property from the father X on 20th November 22, and fair market value of the property as on November 22 was 2 crores. And now he has sold the property on 15th November 24 for 3 crores. Calculate the taxable income or taxable capital gains in the hands of Mr. Y. So here the relevant points are: the property was acquired in 2012. It was inherited by the current owner in 2022 and is selling it in 2024. The fair market value as on the date of inheritance is not relevant. What is relevant is the original cost of acquisition in the hands of the earlier owner, 50 lakhs, sale consideration 3 crores, 3 crore minus 50, 2.5 crores. So 2.5 crores will be long-term capital gains in this hand because the property was acquired in 2012. 2012 to 2024 is more than 24 months, therefore long-term. So 2.5 crores, 12.5% would be the tax on 2.5 crores. Yeah, you have sold. Okay, there were some questions about the rate of TDS. In respect of non-residents, generally the person who is buying the property from you will deduct TDS at 12.5% now. Earlier it was 20%, but now 12.5% plus surcharge plus education cess. There is a sort of there is a ambiguity. There is a difference of opinion on this front as to whether TDS should be at 12.5, the base rate, or including surcharge and education cess. In order to avoid problems with the TDS department, most people will go for tax plus surcharge plus education cess. And ultimately, when you file your return, also you will have to include surcharge as well as education cess if they are applicable to you. Therefore, it doesn't make any difference if the TDS is also at the combined rate. Coming now, you sold your property which has been received by you as a gift or by way of inheritance. Money is lying in your NRO account. From NRO, you can transfer maximum up to $1 million per financial year. From NRE account, there is no limit. For transferring from NRO, you will require 15 CA and 15 CB forms. 15 CB will be issued by the chartered accountant. 15 CA is your self-declaration, which you have to fill up. Your bank, Kotak Bank, will ask you for all these, apart from other documentation. If the money is lying in NRE account, then from there to move it outside India, no documentation would be required. It is freely repatriable. Many times we've been asked that what do I need as a documentary evidence to prove that I have got a gift? Very valid question, because 2-3 years down the line you may be questioned by the income tax department as to prove that this was a gift that you received from somebody else. So ideally, if you have a letter from the donor mentioning date of gift, details of the gift, what is that asset gifted, how has it been gifted, in cash or in kind, the value of the gift, and the fact that the gift is given out of natural love and affection, the PAN number of the donor, etc. All this, if these are mentioned in the letter, it would be ideal, it would suffice. My view is that you don't need a formal gift deed. A simple letter bringing out all these facts would suffice. I may only caution that the moment you have any document in writing which brings out the fact that a gift has been given and a gift has been received by the donor, that tantamounts to gift deed under the stamp duty law, and this would be subjected to stamp duty Technically, 99% of the people don't bother about all this. Nobody pays stamp duty, but technically, legally, you would need to pay stamp duty on that particular letter, which would be deemed to be a gift deed. You may also, if the gift is from a very close relative and there is no problem for you to ask the donor, please get the bank statement of the person who has given you the gift, which shows the gifted amount being debited in his or her bank account. So that would be really helpful in future when you have to establish that X person has given me this gift on X on so and so date. Yeah. When you're filing a ITR return, you will need lots of documents. I'll not get into the details. You can read it from the presentation when you get it. Most important thing to be noted are the AIS and the PIS and the 26 years. These three are like the Bible, the Bhagavad Gita, the Quran for tax purposes. Please pay maximum attention to these three documents. Once when you file your return, as you might be aware, and if you are not aware, let me mention that now in India, everything has to be done on electronic basis. Your return is to be filed electronically. Once you file the return electronically, you have to e-verify it using various options that are available. The options are given in this. You may, go through it once you get the presentation, not getting into the details. The simplest way of e-verifying a return is through a OTP on your mobile number if you have a Aadhaar. Now, Aadhaar is not mandatory for non-residents, but we have come across various cases where non-residents also have got the Aadhaar. If that is the case, the best way to e-verify the return is through the OTP, Aadhaar-based OTP that you will get on your Indian mobile number, if you have. Yeah, lately we have been seeing that many taxpayers are starting to get notices, or rather summons, from the income tax department asking for various details in with reference to foreign assets. Now the government of India has got complete details of foreign assets held by Indians. Now unfortunately, the income tax department, does not know whether you are a resident or a non-resident today. And that is why even non-residents are now starting to get summons that the government has got information that you have got so-and-so account with so-and-so bank in so-and-so country, and you have not disclosed it in your tax return. Please explain why. So you may get these notices. They are questioning your residential status. They are questioning when you opened a bank account. If you claim that you are a non-resident, they are asking you to prove that that asset was acquired by you or the bank account was opened by you when you were a non-resident. So all these kind of questions are being asked, and you need to therefore be ready with the documentation to prove that A, you are a non-resident, B, the assets that they are referring to in their summons are all held outside India. You, being a non-resident, were under no compulsion to disclose those assets to the Indian Income Tax Department, and you have proof that this asset was acquired by you in the year in which you were a non-resident. All these, if you're not able to prove this, they may say that you have violated the Black Money Act, which would have disastrous consequences. For lack of time, I will not get into the Black Money Act because generally it is not applicable to non-residents. But if and when you become a resident Indian, be very careful about how you are disclosing your foreign assets in your Indian tax return. This brings me to TRC, Tax Residency Certificate. It is a document provided by tax authorities to individuals or entities to establish the tax residency status in a particular country. In India, a TRC of your foreign country would help you in availing tax benefit under DTAA, that is Double Tax Avoidance Agreement, between India and other countries. DTAA, there were a lot of questions that can I get DTAA benefit? There were questions like I earn capital gains in India from mutual funds. Is it exempt under this so and so DTAA, etc.? Very interesting questions. So first of all, it is possible that a particular item of income which you are earning in India, you are a non-resident, you are earning certain income in India. That income may either not be taxable in India or may be taxable at a lower rate as per a DTAA. Let me give you an example. If you are living in, say, Hong Kong, for example, and you are earning interest income in India or dividend income in India, under the India Hong Kong DTAA, interest income and dividend income earned by a Hong Kong tax resident in India is taxable in India. It is taxable in India, but it is taxable at a lower rate of only 5%. So if you are not aware of this, you would offer it for tax at the normal rates, but under DTAA between India and Hong Kong, it would be taxable at 5%. Now, if you want to, so there are innumerous examples. For example, capital gains on mutual funds. Under many treaties, the capital gains in India on redemption of mutual funds is taxable in India, uh, but at a lower rate, or under many treaties, it is not even taxable in India. So, for example, Singapore, for example, Mauritius, just to give two simple examples. Under these two, under the DTAA between India and these two countries, if a Singapore resident or a Mauritius tax resident earns capital gains in India from mutual funds, that income is not taxable in India. It is taxable in that other country, Singapore or Mauritius, as the case may be. So you will need to check the DTAA carefully and also have a TRC of that other country in order to get these benefits. In every DTAA, there are different articles for different items or sources of income. In the article dealing with capital gains, again there are different sub articles or sub clauses dealing with capital gains from different kinds of assets. So you need to go through these carefully. Please take professional help if you feel that you can get benefit of a DTAA. Don't rely on Google and don't rely on internet searches for taking benefit of a DTAA. This brings me to almost the end of the presentation about PAN 2.0, which some of you may have heard. Recently, the government made an announcement that they are rolling out PAN 2.0, whereby they are modernizing the whole process of PAN and TAN registration. There was a big halla gulla, big furor when this thing came out, because a lot of people felt that now again we'll have to apply for a new PAN card. There is no compulsion for anyone to apply for a new PAN card. The under PAN 2.0 initiative, the current PAN cards will be replaced ultimately with new PAN card with a QR code. And that QR code is basically what they are trying to, which is the new thing that they are trying to implement. Of course, it was already there in respect of PANs issued, I think, post 2017. But the ones which were issued prior to that did not have a QR code. But now they want to standardize everything. They want to have a QR code on every PAN, but it is presently not mandatory for you to have that. Therefore, there is no cause for alarm or panic that I need to apply for a new PAN card. When this whole thing is in place, there will be a single portal for PAN and TAN related services. Everything will be paperless. That is what they have promised. There will be quicker processing done by them in respect of any applications. And as I said, QR code will be there for ensuring the authenticity. So once you have a QR code on your PAN, that PAN card will serve as a great ID. And if you show it anywhere by scanning the QR code, the concerned person will be able to verify that it is actually you. It would certainly help in the KYC going forward for various asset classes. These are FAQs which are there issued by the government. I'll not verbatim read out all this, but it is there in the slide. You can go through it later. But they are there to set to give you peace of mind that there is no compulsion to apply for a new PAN card just now. There will be no change in your PAN number. Everything remains same. The PAN number remains same. If you have an old card, keep it. Only later, as and when things start rolling out, where KYC etc. also requires mandatorily a QR coded PAN card, at that time you will need a new PAN card. Yeah, we have been told by Kotak Group that there have been some issues faced by a lot of non-residents in respect of the mutual fund investments because of the KYC. We tried to check out with certain mutual fund houses as to what the issue is. Apparently, what has happened is that now, because of the SEBI circular, every fund house is required to match their own data with the PAN data. As a result, they have to match the name which you have given to the mutual fund for when you applied for the units, and they are matching that name with the PAN in the PAN data of UTI ISL and NSC's PAN subsidiary. And if there is a mismatch between the two, there is a problem in your KYC. And let's look at how it works. If your name as per PAN, now here it is important to remember that when you apply for a PAN card, there is a provision given over there that what is the name, how do you want the name to be printed on your PAN card? Okay. So in this example, first example, say when you applied for a PAN card, the full name given was Ravi Prasad Shah. On the PAN card, when he made the application, he mentioned that on my PAN card, just print Ravi Shah. Okay, so invariably, all of us use the PAN card, the card itself as a kind of a KYC. And the name printed on that is Ravi Shah. But in the PAN records of the government, the actual name is Ravi Prasad Shah. In the mutual fund record also, it is Ravi Prasad Shah. So far, so good. In this case, the KYC get validated. But let us take another example. In the mutual fund, you are given Ravi Shah. On your PAN card, it is Ravi Shah. But in the PAN records, it is Ravi Prasad Shah. The KYC may or may not get validated. Here, there is a fuzzy logic that all mutual funds are applying, primarily because they don't have clarity from the government side as to what to do in this case. May get validated, may not get validated. Depends on your luck, depends on the fund house, how strictly they are enforcing the KYC. In an example, same case, the mutual fund has a name Ravi Prasad Shah, but PAN has Ravi P. Shah. In this kind of a case, KYC will not get validated. In PAN, it is Shah Ravi. In mutual fund, it is Ravi Shah. Again, fuzzy logic may be applied by the fund house, may get validated, may not get validated. Ravi Prasad Shah in PAN records, Shah Ravi P in mutual fund records. Most probably, this will not, KYC will not get validated. You will have to get the name changed in the mutual fund record or in the PAN records, either of them. So I have tried to cover as many queries as possible which were shared with us by Kotak Group. If at all there is anything that is missed out, we have, I don't know, depending on the time availability, we could go on for a few minutes, but otherwise you can write to us. We will solve them. Thank you.